The shocking truth behind the most recent crypto crash. This is something they don't want you to know about. And I'm going to reveal it to you right now in one simple, fast step. Step number one, let's go over how this is all part of their plan. Who is they? It's the central planners at the Federal Reserve and the politicians. Their main objective right now is to bring down the headline CPI number or consumer price inflation. And the way they're going to do this, or the way they've been trying to do this, is bringing down asset prices. Assets just like cryptocurrencies. Let's start by going over this chart. It goes back to 1980. Actually, the chart goes back further than that, but we'll start at 1980. It goes all the way to 2020. On the left, we go from 300% up to 650%. So this green line represents the net worth, the combined net worth of Americans as a percentage of GDP. So this isn't how much income they're earning, because adjusted for inflation, that line would be pretty flat, go up very slightly. But this is how much their home is worth, their home equity, their 401k, all of the assets they own outside of their income that gives them an incredible amount of purchasing power. In fact, it's purchasing power. They didn't produce anything to receive. More on that in just a moment. So we can see, going back to 1980, that it was right about 325%, the total net worth of Americans as a percentage of GDP. And then it goes up slightly, about 1990. But if you look at this historically, going back to 1960, this still is at a level that's very consistent going back a few decades. Then in 2000, it comes way down due to the dot-com bust. But then Alan Greenspan comes in and drops rates artificially low, which gives us the housing bubble, and that takes net worth up 500%. We know what happens then. They tried to raise rates, and then all those assets, that home equity, came crashing down. But in the minds of central planners, the cure for too much central planning is even more central planning. So what do when asset prices come down in 2009, going into 2010? They drop rates even lower, down to 0%, and they couple this with quantitative easing. The Fed's balance sheet goes from $800 billion all the way up to $4 trillion prior to the cerveza sickness. And now, or just recently, it was up over $9 trillion. So as the Fed's balance sheet went parabolic, so did asset prices. And we go from about 450% of GDP in 2010 up to where we are today, or where we were just recently, let's say back at the end of 2021, where the net worth of Americans as a percentage of GDP was up close to 600%. And I want to remind you, if inflation was measured today the same way it was measured back in the 1970s, our CPI would be very similar to what it was in 1980 or 81 when Paul Volcker took rates to 18%. But just recently, the Fed has increased rates to what? 1.5%. Why is this? Because they look at this chart, and they also look at charts of the debt in the system. Sovereign debt is at all-time highs. Corporate debt, all-time highs, and consumer debt is at all-time highs as well. So they know that if they take interest rates up to a certain degree, they are going to crush the entire economy, because the government, the corporations, and the consumers can't afford normalized interest rates. Let's say Fed funds at 4, 5, 6%. And they definitely couldn't afford positive real rates. So this would be the Federal Reserve taking their overnight rate above the rate of consumer price inflation, which as measured by the government right now is 8.6%. So you can imagine what would happen to the entire U.S. economy if Jerome Powell took rates to, let's say, 9%. the entire house of cards would come crashing down. So now let's look at the problem of consumer price inflation through the lens or the framework of these central planners at the Fed, the Treasury, the government, these PhD economists. They believe in something called the Phillips curve. And this simply states that there is an inverse relationship between inflation and the unemployment rate. So if the unemployment rate goes down, inflation goes up. If the unemployment rate goes up, then inflation, or headline CPI, goes down. And a perfect example of this is recently Larry Summers has come out and said that in order to tame inflation, they have to increase the rate of unemployment, they being the Fed and the central planners. But this presents a dilemma. This puts them in a very difficult position. How do you increase the unemployment rate without crashing the economy? In their minds, they think, or at least they're saying, that they can do this without creating a recession. Now, I would argue that we're most likely already in a recession, but we'll shelf that for a moment. Again, we're just looking at things through their framework. Well, I think they look at this chart and say, aha, there is the answer. If we can somehow bring down asset prices or decrease the net worth of average Americans in aggregate total, we can bring down the CPI without it having too much of an effect on the overall economy and potentially pushing us into recession. And if we do go into recession, it will be very mild. Again, their words, not mine. So I think the game plan is to raise interest rates just enough to make it seem like you're going to get really tough on inflation, like you're the next Paul Volcker. But don't raise them too much to where you break the economy. And then while you're talking tough, this makes the market believe that you're going to continue to raise interest rates, maybe up to 4 or 5%. So then especially risk assets, start to sell off, like the NASDAQ, the S&P, and definitely cryptocurrency. So how will this bring up unemployment to a level that in their minds would start decreasing the CPI to a point where it's politically palatable going into the midterm elections? Well, I think that one of the big reasons we have a labor shortage right now, and one of the main reasons the unemployment rate is so low, is because people have made so much on their stock portfolio or on cryptocurrencies, or their home equity has gone up to a point where they don't have to go back to work, at least not right now. So if you bring down asset prices, now all of a sudden they're in a position where they have to go back to work. So you turn a labor shortage quickly into a labor surplus. In fact, I heard a great story the other day on one of my favorite podcasts that gives an example of this potentially playing out in real time. It was a story from a restaurant owner who said he lost all of his employees to this boom in cryptocurrency. Because when they would leave, when they would quit, he would say, "Why are you quitting? You've been a great employee for the last year or 2 years." They said, "Because I've made so much in cryptocurrency that I'm going to take some time off." But now all of a sudden, let's say the last month or so, he's seeing all of those employees come back to work and ask for their old job. So I personally believe that if asset prices come down enough, it definitely will impact the unemployment rate. But unfortunately for the Fed, I think it'll also negatively impact the economy. Let's go back to this example I use all the time on my whiteboard videos of a hot air balloon. And the Fed still believes that the balloon part, the part that's carrying around the basket, is the economy. And the basket, pretty much asset prices. So wherever the economy goes, so will assets. But in my opinion, it's completely switched. And I think that this chart proves that it has switched. From a standpoint of now the hot air balloon isn't the economy, but it's asset prices themselves. And the basket is now the economy. So wherever asset prices go, so goes the economy. And I don't think the Fed has figured this out yet. And if they have, they won't admit that the US economy is now completely and utterly dependent upon asset bubbles. In other words, it's impossible to bring down asset prices to a level that would negatively impact unemployment enough to bring down CPI without throwing the United States economy into a recession, if not a depression. So the main takeaway is I think the Fed is going to increase interest rates just enough to make it seem like they're getting tough on inflation. They're also going to continue to try to talk down the market through expectations policy by making the market believe that they're taking a very hawkish approach. They're going to combine this with quantitative tightening, which is reducing the size of their balance sheet. Editor, go ahead and throw up a chart, and we can see that there's a direct correlation between the Fed's balance sheet and the S&P 500. So again, in their minds, they can try to have this soft landing where they increase interest rates just enough and bring down asset prices just enough to bring down the CPI just enough to where these politicians believe they have the highest probability of getting reelected. At the end of the day, this has nothing to do about the average Joe and Jane or what's best for society. It has everything to do with what's best for the politicians and the central planners. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.